Hi everyone, I'm Irk and this is Get Irked, my channel dedicated to helping anyone learn how to invest in the stock market without the use of day trading or risky strategies. My goal is to make it so that anyone can invest, even if you're like me and you have a full-time job, and still beat the markets. Long-term investing can be tricky, particularly when it comes to when exactly do you buy the stock. Few things can be as frustrating as buying a stock and having it immediately drop in price after you buy it. In fact, I'm pretty sure the stock market knows exactly when I'm going to buy, and all the major hedge funds just sit around and wait so that the instant I buy, they can force the stock down 5% just to make me feel good about myself. How exactly can you protect against this? I use a strategy called buying in stages. The concept here is that you don't buy your entire position all at once. You buy it over time. There are several different approaches that you can take in how you buy in stages, and I'm going to talk about three of them. I'm going to talk about dollar cost averaging, I'm going to talk about percentage-based buying, and I'm going to be talking about buying using pretty basic technical analysis strategies. In order to accommodate all levels of investor, I'm going to assume that you have a brokerage that allows you to buy fractional shares. That way we can talk about the percentage of money that you're putting to work instead of having to worry about whether or not you can afford a share of Amazon, which is currently trading at over $3,000. If you're not using fractional share trading and you're able to buy whole shares, I want to talk about the difference between a market order and a limit order. A market order is when you go in to buy X stock and you want to buy Y shares. You put the order into your broker and they immediately put it out to the market. And whatever price the market might have, that will be what you get. The problem with this approach is sometimes there can be dramatic volatility. And so the price that you end up getting can be significantly higher than what you had originally intended. In order to protect against this, you should always use a type of order called a limit order. A limit order is where you tell the broker that you want to buy X stock, you want to buy Y shares, but you only want to buy it at this price or lower. When you put in that order, it won't fill until the stock drops to your price or lower. So let's say it gaps down overnight. Your stock price was $100 a share and it's at $90 a share in the morning. You'll actually get the stock around $90 a share because it's better than your $100 price. If you'd put in a market order, it may have been anywhere from $105 to $90. Who knows at the beginning of the market because there's so much volatility. And since we're investing for the long term, it's about getting the price you want. Dollar cost averaging is the simplest way to invest for the long term. For the purposes of this video, we're going to assume that you have a flat amount of money. And to make it simple so that it's not too intimidating for someone just starting out, we're going to say that it's the amount of the stimulus check that's coming up, $1,400. First, you'd pick 5 different stocks from 5 different sectors so that you can be diversified. If you look at my videos, you can see how to pick the best in breed stocks. This will talk about diversified portfolios and why diversification is so important. Divide your account's total value, in this case $1,400, by 5, the number of positions that you're going to buy, and that gives us the amount we're going to put into each position, $280. Next, you decide how many transactions you want to make. In this example, we're going to say that you want to choose 5 times that you're going to invest, and we're going to invest once every month for the next 5 months. Each purchase is going to be $56, and we're going to use a monthly time frame. If you're feeling a little bit like you'd like to be in the market, maybe it's at a low point, then you should put your first order in the middle of the day, the next opening day. If that's the 5th of the month, you've just set what day you're going to be buying in, or whatever day is closest if the 5th falls on a weekend. For the next 4 months, regardless of whether your stock is up or down or the market is up or down, you're going to make a purchase of $56. And at the end of the 5th month, you'll now have your full position size, dollar cost averaged. That's what it means, is you're buying and taking into account that there might be some volatility, and so you're going to get the best average price over time. The next strategy is percentage-based buying, and it's slightly more complicated than dollar cost averaging. Just like dollar cost averaging, you're going to pick the number of buys you want to make. To keep it simple, we'll say 5, so $56 each. If you're feeling FOMO once again and you want to get started, you would do your first purchase in the middle of the day. You always want to let everything kind of settle in the market. It's really volatile in the beginning of the day, and the first hour and a half they actually target new buyers and new investors because people are going to be buying in really excited. So it's often the worst time in that first hour and a half from 9:30 to about 11 o'clock Eastern time. That's the worst time to buy because you'll get the worst prices. If you wait until noon Eastern time, the market will usually be settled out. It's lunchtime for the brokers. There'll be less volatility. So if you put your market order in then, if you're buying in fractional shares, you have to use market orders. You do your first buy the next trading day in the middle of the day. Now from here, we're not going to be following the same strategy that we were talking about dollar cost averaging. You've just set your cost basis. Let's say you bought a share of a stock at $100. Now you want to do percentage-based buying. How much of a percentage range you wait for your stock to drop before you buy is entirely up to you. You can wait until it drops 5%, you can wait until it drops 10%, you can do whatever you want. If you're using limit orders, it's very easy to determine exactly when you're going to buy. Take your cost basis, take 5% out in increments, and take out as many as you're going to do. So your first buy was $100. The next buy would be at 95, 90, 85, and 80. That gives you 5 different purchases. After your last buy, you now have a full position of the stock, but instead of having a full position at $100, you have a full position of $90 because you averaged in with your percentage-based buying. It gives you a 10% discount. It means you have 10% more money in that stock. If you're buying using fractional shares, it's going to be slightly more tricky. Most brokerages allow you to set price targets where it will actually alert you. If you want to use a service like TradingView, you can set it up so that you set the price you want an alert, and it can even text you so you'll know that's when you put in your order. Since in fractional share trading, you're going to be buying at the market rate, you might not get exactly 5, 10, 15, 20% off, but you'll get pretty close if you use those alert strategies. You can even make it so that your alert would be a little bit lower than the target so that you'd have some time to put the order in. Technical analysis-based buying is very similar to the other strategies, particularly the percentage-based buying. Instead of using a percentage drop, you're actually going to use a service like Yahoo Finance or TradingView and look at the stock over time. I usually like looking at the stock on the weekly chart because it shows a little more consistency than the daily chart in terms of patterns and a little less volatility than monthly, where you might be waiting too long or you might not be able to get the price that you want. Once again, you're going to pick how many times you want to invest. We're going to stick to the same formula of 5. You'll do the same thing as percentage-based buying, and you'll buy your first buy in the next trading day midday, a fifth of whatever it is, $56. And then you're going to look at your charts and figure out where you see a lot of support. If you've never looked at a candle-based chart before, you might be a little overwhelmed by what you're looking at. Each candle represents whatever time frame you're in. So if you're in the daily chart, one candle is one day. Since we're in the weekly chart, one candle is a week. If the candle is green, that meant your stock went up that week. The top flat part of the candle is where the stock ended the week. The bottom flat part of the candle is where it started the week. The wicks are the low and the high respectively. If the candle is red, the top flat part is where your stock started the week. The bottom flat part is where the stock ended the week, and once again, the wicks are the high and the low. So looking over time, you'll see specific points where there's a lot of clustering of these candles. These are candlesticks where it indicates a point of support, a potential place to buy. If you're feeling conservative, you might buy on the low end. You might buy where a lot of the wicks are overlapping each other. But if you're feeling like you really want to get into the stock, you might buy above the bases of the candles. That's a more certain way that you probably hit the price if the stock pulls back to that level. If the stock doesn't bounce up from there, you're going to look at the next level and say that will be my third buy, and so on until you get down to your fifth. So there you have it, 3 different strategies to get started buying for the long term. By buying in stages, you avoid the FOMO of not being able to get started right away, but you also avoid the pain if your stock sells off. Now, it's important to remember this strategy, you're going to want your stock to sell off sometimes, and that means getting yourself steeled around the idea that you'll be down in your position. A lot of new investors might be very uncomfortable when they've lost money, and you have to wrap your head around the stock is going down, it's on sale, and it's at a better price. So what happens if you're buying in stages and your stock immediately goes up? Well, this is actually a high quality problem. If this happens, you can either choose to buy your cost basis up, which means buy at higher prices and raise your initial price. I don't like doing that. What I'll do is I'll just wait. If the stock never comes down to the prices that I want, I'll take the remainder of the money that I would have invested in that position and find a new position for that money to go to work.